Hi, Orlando. Thank you very much for taking the time to meet with me today in your offices in Miami. It's an honor for me to have the opportunity to interview one of the pioneers of software buyouts in North America. Could you please first introduce yourself and maybe share with us the key milestones of your successful professional career?
Well, thank you so much for having me. And most importantly, thank you for your incredible partnership with our team. It really means a lot to us. And we have had great interactions, and your team has done excellent diligence on our funds.
Thank you.
I feel you really, really understand us very well at the detailed level. I'm originally from Mayagüez, Puerto Rico, a small town in Puerto Rico. And I give you that because for me, there have been so many little steps that are transformational and make who I am as a person today. Everything in my past has been like a very special moment. Even today, when we get to buy and our funds get to buy a big software company, it's just so special. And I take that very, very, very seriously. From a career standpoint, I can give you my two highlights, and they're around mentorship and the people that taught me the business. One key area was when Carl Thoma, the co-founder of our firm, hired me in 1997. He became my investment mentor. He started in private equity in the 1980s, and he taught me all the fundamentals of good old-fashioned investing, the values of the business, and the ethics around private equity and what we do. Marcel Bernard, a big second milestone as a mentor for me. Marcel Bernard ran Motorola divisions in the 1970s when that was a phenomenal school of management. He came in and he became my operations mentor. He taught me and the team how to really run a software company.
And what is your role today at Thoma Bravo?
So at Thoma Bravo today, I run our firm. Now, I run it together with our managing partners and our senior partner. We work at Thoma Bravo in a collaborative way. And just to let you know how our team works and what it means to run it together with my partners is, the managing partners of Thoma Bravo have been together for almost 20 years. We now have 20 partners in our firm, and in our entire history in equity buyouts, we have never lost a partner. That means that we have a lot of collaboration, we're on the same page, and we work on things together. I focus on three things at Thoma Bravo. One is on our partners, like we just spoke about. Our clients, our partners, making sure we're transparent, we're achieving our goals, we're communicating clearly. Second, I look to help the team buy more great software companies. And third, I look to help the team improve the operations of those companies. I tell everybody in the organization that those are the three things that really matter for us. Have great partners, buy great companies, and improve the performance of those companies.
Very clear. And could you please tell us about the history of your firm, Thoma Bravo?
We have a very long history that is divided in parts. So our firm got started, our predecessor firm, in 1980 by Carl Thoma. That was one of the firms that invented industry consolidation, putting companies together. That's something that we do now in the software industry. Our entry into software and who we are today started in the year 2000. That's when we did one of the first software take-privates that had ever been done by a private equity firm. And since then, we have built the business what we call one deal at a time. It was the year 2000. The internet bubble had just burst. And we had a theme that we could buy software companies cheaper in terms of their recurring revenues than any other industry that was out there. At the same time, software companies were not profitable then, like they're not profitable now. So we needed to come up with a way to increase their profitability to make them long-term fundamental investments. The first deal we did was successful. So we did another one and it was successful. Then we did a third, it was successful. And we were generating good outcomes from these deals. So we said, let's just focus on it. And that's what we've done now over the last 20 years.
And what makes software, your target sector, so attractive for buyout funds?
Software is really the best for private equity. And I tell you why. There are three key reasons. Number one, software is an outstanding business. Your gross margins are 90%. You have intellectual property protection. You have recurring revenues that usually renew at a rate of 90% plus. You have the ability to consolidate the market. It's a really good fundamental business. When you look at the cash flow these companies produce, they're higher than earnings because these companies get paid in advance. When we started in software, we saw very quickly that software was better than the underlying sector it was serving. For example, would you rather buy a school or the software company that runs the school? Would you rather buy a distributor, a manufacturer? You can say this across so many industries. The second reason is software is the future of every business. We say that every company needs to become, in the future, an intelligent software company. So you have some very, very good trends. And third, and very important for private equity, there is so much value that you can create from these software companies. In our flagship fund, we are usually buying a company that has 500 million in revenues. They're the market leader. They have 2,000 customers or more. They're just in a very, very good position, but usually they're not making money. And that's where groups like us come in and can really improve the profitability and create the value.
Could you please give us your perspective on the evolution of the software leverage buyout market?
It has been an incredible evolution. The software LBO was really without leverage. Starting around the year 2000, that's when we did one of the first deals in software, and I think one of the first, if not the first, take private of a software company, from a listed company to a private company. And at that time, you could borrow very little money. You were buying these companies at 1 to 2 times revenue and really making your return through operational improvements. There was not that much leverage. That was from the year 2000 till the year 2005. Then in about 2005, the credit markets, the investment banks, came in to heavily finance software companies. I remember at the time we did a deal called Datatel, and Credit Suisse led a syndicated financing of that company. Now that was short-lived because in 2007 came the financial crisis. That stopped leverage for about 2 years. So once again, these deals were being done at a lower price, but with no debt, but still for control. That completely opened up in 2010 and 2011. Lending for software buyouts became extremely popular, especially since the industry went to software as a service and subscription. In 2016, private credit started getting into the business. At that time, we did a deal, a take private called Click Software. It was $1 billion private credit finance deal that the Financial Times at the time wrote that was the largest private credit deal done then. Imagine now, you have now billions of dollars in credit that come in to finance a software buyout. At the beginning, in the year 2000, software as a percentage of all private equity deals was 2%. Today, software as a percentage of all private equity deals is 30%. Incredible. And that number is going to keep going.
The size of software buyouts has increased materially over the last decade. And you have also increased your deal sizes with your flagship fund. We're often concerned about the lack of exit options for very large businesses. There's often only one exit route, an IPO. But you have actually proved your capacity to sell very large software businesses to trade buyers. Could you please comment on the growing appetite of trade buyers across all industries for large software businesses?
But that's the beauty about private equity, is that you can exit to trade buyers. If you can buy companies on a proprietary basis, improve them materially, and then sell to trade buyers, that's the business model, and that's our business model. You just need to call them and be proactive about it. Now, these are the dynamics, okay? Our strategy is to buy the number one player in business-to-business software in many different categories. And we have a reason for that. And then improve them materially from an earnings standpoint and industry consolidation standpoint. So when you do your job right, you do end up with a large asset. It is true that there's not thousands of buyers for these assets, but they're the right buyers. And the dynamics are as follows. There are very few software companies that fit the criteria for these large strategics: scale, profitability, and growth. When you put those three together, there are very few of these software companies that meet their needs. Now on their side, you currently have $1.4 trillion of cash sitting on the balance sheets of these software strategic buyers that have gotten huge, so they need significant scale. And third, on top of that, most of the buyers of these software companies are non-software companies themselves. For example, in France, Thales, the great large French conglomerate, just bought Imperva, one of our cybersecurity companies.
Who are the typical investors of Thoma Bravo, and what is their average ticket?
We have so many great investors, and I hope you can tell from the beginning of our talk, we love our partners, and we love serving our partners. We're very clear about that. We have most large institutions as LPs in our funds, from great state pension plans to Canadian plans to sovereign wealth funds around the world. We have most of them as partners, and many as very, very long-term partners. We also have foundations, endowments. We have many great high net worth individuals. And we keep expanding our base of friends. Even if we've had some for so many years, we always get a few new friends into our funds that we try to deliver value for.
Could you please elaborate on 2 to 3 buyout transactions of Thoma Bravo? Explain how Thoma Bravo sourced them, how you are creating or have created value in those companies?
So our process should look the same on every deal, from a sourcing, quality of business, and value creation standpoint. Each project may have different tactics and different elements to it, but it all is consistent. The way we source is we have dedicated teams in every area that we're interested in. In cyber, for example, we have 2 teams, one for individual identity, one for outside the firewall. We cover infrastructure software with a dedicated team. We cover many areas of applications with teams. These groups proactively look at companies, many of which we've looked at for 20 years. We just bought a company a few years ago called QAD. They were my first cold call in 1999 when we were looking to get into software. It took that long. But that gives you the chance to watch these companies over a long period of time, develop a relationship with management, with their boards, and watch their evolution. I'll tell you about 2 deals that should fit this description. Years ago, we bought a company. We took private a company called CompuWare. We paid $2.2 billion for the business. CompuWare was mainly seen as a mainframe software company. But in it, they had an asset called Dynatrace in infrastructure software. And what Dynatrace does, it connects all cloud environments and manages your cloud environment for a company to make sure that that environment is working so you can transact with your customers, market, communicate. We bought the business and split it into 2 parts. CompuWare, which we ended up selling to KKR, and Dynatrace. When we inherited the company, it had no profits. It wasn't linear, and these projects are never a straight line all the way up. We had a number of issues, but overall we ended up with a company with high 30s EBITDA margins, fast growth, and a next generation product. One piece of the business, CompuWare, we sold. The other one we took public. Another similar example is a company that we recently sold to NASDAQ called Adenza. It has that international component. We started by buying a company from a founder called Axiom. And there was a great relationship that my partner Holden Spade built with the founder of the company based in New York. Axiom ran all regulatory processes for banks, particularly in the US. Right after, we were able to buy a company called Calypso in Europe that runs all regulatory processes for investment banks and trading firms. Combining the 2 businesses, we realized significant synergies, significant uplifts, both in revenue and margin. And recently we sold that company to NASDAQ for roughly $11 billion.
Great. Turning to the market now, what's your perspective on the current market environment? Is it a good time to invest?
So I'll divide that question into 2. One is it a good time to invest in general? Nobody ever knows. I cannot predict the economy. I cannot predict valuations. Luckily, I don't have to, because I always say we don't buy the index, we don't sell the index. We buy a specific company with leadership we need to work with things that we need to build, with things that we need to fix and improve. Now, for us, the time to buy a great software company that fits our value creation strategy is when we can. That's the way we see it. And in any market, in private equity, you really should be market agnostic. Think about it. There's a $10 trillion ecosystem of publicly traded software companies. Within that world, could each of our funds find 3 great companies a year that we could buy, improve, and work with management and build? That should be the answer. That should be absolutely yes, whether the market is high or low, or growing rapidly or not.
And how do you see the private equity industry evolve over the medium to long term?
Private equity will become all about software. Companies themselves are transforming their businesses to software companies. So as managers in private equity, in any field, they will look more towards going digital, towards their digital aspect of their businesses. That 30% statistic that all private equity deals are now 30% software, that will go in the medium term to 50, 60%. And it'll become indistinguishable between what is a pure software deal and what isn't. Second, private equity will continue to grow because it is a better form of ownership of many companies, especially those that are going through transformative legacies or areas of their business.
And what's your perspective on the impact of artificial intelligence on software?
Artificial intelligence is an absolutely incredible tailwind to software companies. The incumbents have such a huge advantage. Many of them have the proprietary data in what they do that is necessary to train these newer and very exciting models that people talk about. Without that data in that use case, it just cannot happen. It doesn't happen. Aside from their data, many of these software companies have the pre-existing customer relationships and know-how either about their specific business, their specific problem, their specific cybersecurity need, so that they can add these capabilities to what they're doing currently for their customers. It's very similar in a way, but could be more powerful than the transformation that happened in software from licensed software to software as a service that is still ongoing to now becoming an intelligent company, which is the next phase and the next evolution.
Thank you so much, Orlando, for taking the time to speak with me today to talk about you, about Thoma Bravo, and sharing your insights on the market. Thank you very much.
Thank you so much.